educational purposes only, should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Welcome, everyone. OptionVue has been in existence since 1983, primarily involved in the high-end options analytics field. Our software is the best in the world for the off-the-floor trader in terms of modeling accuracy. The only way to get more accurate options modeling is to work for Goldman Sachs, one of those hedge funds or institutions where they have a bank of programmers on the inside. And so we spun off Discover Options about 12 years ago as our educational arm, and we primarily involve ourselves in the one-on-one mentoring experience. And then a few years ago we came out with the VXX Trading System. Today I'm going to show you everything about this and the philosophy, the indicators, and a lot more. Take a look at this equity curve here. This is the equity curve of our advisory signals that we began in March of 2016. March of 2016. And $10,000 invested then using the signals we've generated, okay, would be have an annualized return since then of about 100%, to a total return of 250% going back then. And so I'm going to give you details of our advisory later on, but as you can see, the returns are just outstanding, and there's a very good reason for this. We go deeper than just looking at charts. In fact, we do not look at charts at all. We do not look at technical analysis of price action at all. We take a completely different angle that I'm going to explain to you here today. Notice that with these outstanding returns, we do have some drawdowns. So that's something to to keep in mind, is that if you do decide to allocate a portion of your capital to this approach, that you can have 30% drawdowns. The largest drawdown we've had since then is about 31%. And what's nice here is that the actual results we've seen is an extension of the tremendous level of back-tested returns we did before this. And I'm going to show you results of that in a bit as well. So with that in mind, let's press forward and see what the system actually does. So the VXX Trading System was developed by Lentz, our founder and chief programmer, and it times the entry and exit for your capital to be placed in one of three different locations. You could be long the VXX, that's the iPath S&P 500 VIX short-term futures exchange traded note, or your capital could be long the SVXY, that's the ProShares short VIX ETF, or your capital could be on the sidelines in cash. Now note that both of these exchange traded products pertain to something called the VIX. What is the VIX? So those of you listening, some of you may understand the VIX. Those of you that don't, let's digress a little bit for just a few minutes and examine what the VIX is. And so here you're seeing a bar chart of the S&P 500 index with two lines underneath it, the blue and the red. Never mind the red line. That's the actual volatility or statistical volatility of the index itself. Look at the blue line. That's the VIX, or the implied volatility. Now what do we mean by that? Okay, back up for a little bit. All right. The Chicago Board Options Exchange, CBOE, or what we call the CBOE for short, all right, they have the exclusive licensing on the S&P 500 brand or name. And so, and that they have the exclusive licensing on that index, that S&P 500 index. And so with that index, the CBOE has a huge market of cash options on that index. It's been around for many, many years, and those options trade over $1 billion a day now. It's a very liquid market for options, and those options have time premium that can be measured. When the options get really expensive, the time premium in those options implies a higher level of volatility in the future. When the options are cheap, okay, when volatility is expected to be very low in the market, all right, then the volatility implied in the future from the time premium drops. And so that's what we're measuring here in the blue line. In fact, you can note here that when the market begins to go down, note that the blue line begins to go up. And when the market bottoms and goes up, then the implied volatility, or the VIX, begins to come down. All right, now what's going on there? Well, what's going on there is a vast population of institutions and money managers that are sitting on billions of dollars of long equity positions. And when the market begins to go down, they can't just quickly get in and, to get out of those positions and then back in. Some of those positions are so large, they would take days. Some of them take weeks to unwind, all right, to try and do it efficiently anyway. And so what they do then instead is when the market begins to go down, they will hedge their long holdings. And one way to hedge your long holdings like that is to purchase put options in the S&P 500 index. So when the market begins to go down, like it is right here, you can see then that the institutions are rushing in to buy put options. They're driving the price of the options up, 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 up. And then when the market bottoms and goes up right here, what happens to the blue line? It comes down. So we have an inverse relationship that you see here. Okay, so after several years of publishing the VIX number, or this blue line, the VIX became a very much watched indicator of the market. And so then the SIBO had a great idea. They came out with a futures market on the VIX. You can have a futures market on most anything. The price of corn, currencies, crude oil, interest rates, all right, any number of things, cattle, I mean, and so they came out with a futures market, on the VIX itself. So now, when the market begins to go down, instead of buying just put options, institutions and money managers can do what? They can go in and purchase or go long the VIX futures. They could go long the VIX futures instead. It's another way to hedge. And indeed, today there is a vast market for VIX futures traded at the Chicago Board Options Exchange. So with that in mind, with the fact that there's a vast market of VIX futures, let's go back and take a look at what the VXX trading system really is. All right, so if you're long the VXX, that's an exchange-traded note that manages a long VIX futures position. Okay, your money then is being, if you buy shares of the VXX, much like you would buy stock, your money is being used in a fund, so to speak, to adopt a long VIX futures position. If instead you're long the SVXY, that's an exchange-traded fund, an ETF that manages a short VIX futures position. So if you buy shares of either one of these, note that you are not personally trading VIX futures. Someone else is doing it for you. For you, it's much like buying simply shares of stock. You could do it in your retirement accounts, 401ks, IRAs, etc. And of course, if you're not in either of these exchange-traded products, your money would be in cash. Okay? Now, before we get into the philosophy of how you swing in and out of these, any one of three positions, full disclosure here, we have a VXX trading advisory. We email out trade alerts and signals as they come up. We give you access to all the proprietary indicators I'm going to show you today here and more. They're available on a website, and also if you are an OptionVue subscriber, you have those available to you in your software itself. And then we have a monthly status email that goes out, and then a subscriber forum that's fairly active as well. More about all this later. Finally, before we get into the philosophy, note that if you do allocate capital towards this approach, that if you are trading the VXX and the SVXY, these are liquid items. The VXX averages over 27 million shares traded per day. The SVXY averages over 8 million shares traded per day. So if you get a signal, note that you have the liquidity there to quickly make a transaction. Here is the heartbeat of the Yates VXX trading system. It's called the YVI, or the Yates VXX indicator. It is a 15-day moving average of a component that's going to take me a few minutes to explain. But suffice to say, when this indicator, I'm going to explain everything about this, just bear with me here. When the indicator rises above a certain threshold, that's a signal to go long the SVXY. When the indicator drops below that threshold, that's a signal to go back into cash. Here it took about 3.5 months of being long the SVXY before we went into cash. 2 weeks later, we went long the SVXY for another 3.5 months, exiting into cash. 2 months later, the system went back long the SVXY, exiting into cash roughly 4 months later. So clearly, folks, this is not a swing trading approach where you're in and out every few days. Indeed, positions can take weeks to months to mature. There's a very good reason for that. As I mentioned earlier, we are not looking at technical analysis of price charts at all. We are looking underneath the price behavior, and I'm going to explain all this in a little bit, but we are going deep to see what drives these prices. Let's take a look at these signals and how well they did for us starting back in 2016 with a price chart of the SVXY itself. Note that here we started our advisory in March of 16, and on March 7th we had a long signal for the SVXY when it was at 345. It exited into cash on June 23rd for a gain of about 41%. And then 2 weeks later, it went long the SVXY on July 7th at 432, exiting November 1st for a gain of 35%. Then 2 weeks later, going long at 657, exiting into cash way out in March, mid-November all the way to the end of March, for a gain of 73%. So imagine, if you will, that you allocated some of your capital and you made 41% on that. Okay? Then 2 weeks later, it's time to reinvest on this signal that we get, and not only do you invest your original capital, but also the earnings from the previous trade. Then that total position makes 35%. Then, when you get a signal over here to go back long, you invest all of the original capital plus all those profits, and then that amount gets 73%. You can imagine that doing this means that your capital can begin to exponentially grow very quickly. It can grow very quickly. In fact, if we ran this all the way back to January of 09 and said, what if we had $10,000 and we reinvested full strength at maximum capacity, margining even, going 2 times the investment, and just went pedal to the metal the whole way? 10,000 would be worth over 8,900,000 today. Pretty darn good. That was 37 trades over that time, 62% winners, 39% max drawdown in that time. Now, since coming out with our system in March, we've had a 31% drawdown. So everything is kind of and 100% returns since then. Annualized returns. So it's all working according to plan in terms of how well our back testing worked, and then how well the forward testing is working as well. Okay. What I want to do now is examine, why does this work? I already told you it does not work because we're looking at technical analysis systems of price charts. We're doing something much, much different. We are looking at something called the daily roll. The daily roll. And to explain the daily roll, and it's very important that you understand this if you're going to invest your money in this way, the daily roll comes from the price structure of the VIX futures. So here is a list of VIX futures as of January of this year, early January. And at that time, the VIX futures were priced where you had January priced at 1090, Feb priced a little bit higher, all the way down to September priced at 1608. Now, why are the prices changing month by month as you go further out in time? January 2nd of this year, when we took this snapshot, the market was very bullish. The market was going up and up, up and up. And if you think about it, well, let me ask you this. Let me pose this question. Which to you is more volatile? A bullish market in the S&P 500 or a bearish market in the S&P 500? If you've been around for any length of time at all, and hopefully maybe you were around back when the market had its hiccups in the fall of 2008, you would know, or even at the beginning of this year, think about all the volatility we had in February. You would know that a bearish market can have far greater volatility than a bullish market. Far greater volatility. And so When we look at this price structure, it makes sense because if we're in the middle of a bull market, we know that in the next few months the market's probably going to stay bullish. The volatility will be fairly stable. But you know what? The farther out in time we go, the greater probability there is that we'll have a bear market, and with that bear market comes what? Higher volatility. So that's why you see that farther out in time we go. If we're in a bull market and we go farther out in time, you see then that VIX futures level gets higher and higher. That's why, and that's what happens in a bull market. Now, think about this. If we're in the middle of a bear market, if we're in the middle of a bearish market, what would this price structure look like then? Indeed, these numbers could be completely inverted, because if we're in the fall of 08, or if we're in the February of 2018, we're all on pins and needles. The market's been going down. The daily ranges are huge. The opening gaps can be extreme. And we're all kind of freaking out, right? But you know what? We know that eventually, over time, the farther out in time we go, there's a great likelihood that the market's going to bottom. The Warren Buffetts of the world, who are sitting on billions in cash, will swoop in, purchase all the great bargains there are out there, and the market will bottom and then begin again its long-term upward ascent. Its long-term bullish bias will continue. All right? So indeed, these numbers, and what we would have then is would be a descending term structure. What you see here in a bull market is an ascending price structure where we go low to high. Okay? That's an ascending term structure. In a bear market, we would have a high value in Jan going lower into Sep. That would be a descending term structure instead. Okay? All right, so with that understood, let's now go look at a quote from Larry McMillan. He's a very famous options researcher, and he came out with this idea back in February of 2012. And this is lifted straight from his newsletter, where he first put the idea forward, and we really teed off on it here. He's a good friend of ours. Larry's a great friend of OptionVue's, and we really respect him. Let's take a look. Both the VXX and the XIV, or the SVXY, I'll stop right there. The XIV used to be the avenue of choice for those that wanted to short the VXX, or excuse me, short the VIX futures. In February, though, it basically blew up so bad they stopped trading the XIV. And you should know that the VXX trading system was out of the VXX. We were nowhere near the XIV for weeks. All right, I'm going to say upwards of 3 weeks. Our system had us out of the XIV weeks and weeks ahead of time. We were nowhere near it. So bottom line is, they don't trade the XIV anymore. The SVXY is the venue of choice for those that want to short the VIX futures. Okay, so let's just substitute that in. Both the VXX and the SVXY are constructed in such a way that they actually own, like in the case of the VXX, or are short, like in the SVXY. Here's the important part. The two VIX nearest month futures. Okay? Each day, part of the position is rolled forward so that a constant 30-day forward position is simulated. Now, when the term structure slopes upward, like what I just showed you, which it does most of the time, that daily roll is a debit, and it's a drag on the performance of the VXX vis-a-vis the VIX. Now, however, since the SVXY is the opposite, that daily roll now is a boon to the SVXY. I'm going to show you an example of this. It'll be very clear when I show you an example. No worries. Now, conversely, when the term structure of the VIX future slopes downward, like in a bear market, that daily roll forward for the VXX is a credit, allowing it to outperform the VIX, and consequently, that daily roll is a detriment to the SVXY. Look at this example. All right. Go to the left side. Let's assume you have shares of the VXX. Your money is being used to adopt a long position in the front 2 months of the VIX futures. You're long, okay? You're long the front 2 months. Now, every day we have to peel off a little bit of the front month and add to the next, because we have to maintain that 30-day forward position. Remember that? So if we're going to peel off the front month, add to the next month, that means we have to peel off the front month by selling some of our long positions and adding to some of our long positions in the next month out. If we sell the front month at this price, buy the next month at this price, we would be selling low, buying high. That's a debit, and that debit can actually have an impact on the VXX, the actual price of that exchange traded product. In fact, we actually document it and we give it to you as an indicator so you know precisely how much that daily roll is, and it can be substantial. I'll show you an example near the end. Now, let's go to the right side. Let's assume you have a position instead in the SVXY. That means that your money is being used to have a short position in the front 2 months of the VIX futures. All right, and every day then we have to peel off a little of the front, add a little bit to the second month, meaning that we have to buy a little bit back of our short position, sell a few more, and increase our short position in that next month out. That's a daily roll that has to occur. We would be buying at a lower price, selling at a higher price. That's a net credit. That credit can help out. That can help out the price of the SVXY to a significant degree. Okay, so this is the daily roll and how it can impact the price of these two underlying exchange traded products. Let's go back to Macmillan now that we understand this. So the idea behind the trading system is simple enough. When the VIX futures slope upward steeply enough, like what I just showed you, we're in a roaring bull market and we want to own the SVXY, meaning we want to be short the VIX because the daily roll is beneficial to the SVXY and because VIX is expected to decline. Now, on the other hand, when that slope is downward, like in a bear market, we want to do the opposite and own the VXX because the market's bearish, VIX is increasing, and the daily roll is beneficial to the VXX instead. So folks, it's like this. We just sit back and we look at the daily roll. Okay, we're not looking at technical charts. We are looking at that daily roll. When that daily roll gets strong enough in one direction or the other, we then put up, it's like being on a sailboat waiting for the wind. All right? When the wind is blowing in the direction, when that daily roll is really benefiting the SVXY, we're going to put up the SVXY sail, go along the SVXY and ride it for as long as that daily roll is going to take us, as long as the wind takes us. When that daily roll subsides, like the wind will die down, we then pull the sail in and we wait. We go into cash. And whichever way the wind blows again, the daily roll rises up, it gets strong, we go in that direction. Okay, make sense? Now, every good sailor has a good set of navigational tools. And let's take a look at what the navigational tools are for the VXX trading system. And our main tool is called the VIX diff. The VIX diff. This is an indicator uniquely created in OptionVue by our company using historical data. It measures the difference in the prices of the front 2 months of the VIX futures. We take the second month minus the first month to get the VIX diff value. Here we have 12 minus 1090 is 110. All right, now notice if we had had an inverted price structure, Jan could be higher than Feb, and then we'd have a negative number. We cannot post a negative number in the last column in a quotes display. You cannot have stocks with negative values, for example. So what we do is we take that value and add it to a base 0 of 10. Okay, and so if we have an upward price structure like this, okay, we're in typically a bull market, we're going to have a value here above 10, and we're just going to take that $1.10 and put it in the change column of our OptionVue quotes display like this. All right, if it's below 10, that means that we have an inverted or a downward price structure. We're in a bear market, and then you'd have something in the 8s and 9s. Now watch what we've done. This is amazing. OptionVue has gone back many years and has created this VIX diff calculation in terms of bar charts, open, high, low, and close. We monitor that throughout the day, and we have this great set of data Base 0 is right here at 10 that you can see. And we have data going back to 2009 or even before that. So for us to run back testing, we've had to go back and recreate all this. And that's what we do here, is we collect data and create data. It's awesome. So we have this data, and we started out by just using a simple 15-day moving average. All right, and we created a system based on it, but that didn't take too long before we began to research other ways of improving the signals. And so we came out with what you see underneath. This is the YVI, or the Yates Volatility Indicator. You'll note that the shape of the blue line above, that simple 15-day moving average, varies from what you see below. Indeed, we determined that we needed to alter and adjust the moving average to improve the signals. So what you have now is a Yates VXX indicator, a YVI, that is a 15-day moving average of the VIX diff, proprietarily adjusted and altered. All right, and this is available to you if you're a subscriber. We give you this indicator. It's no problem. We rescaled this also. You can see here you have 0, and then and so we created these thresholds now, such that when the YVI crosses above 0.96, that's a signal to go long the SVIXY. When it crosses below +7, that's when we're in cash. And then when it goes down below -0.7, that's a signal to go long the VXX. When it rises back above -5, that's when we're in cash. Then, of course, if it goes back above that 0.96, then we are long the SVIXY. So we have three different zones that define whether we're long either of the ETFs or simply into cash. And this is the timing mechanism that we use, like that sailboat analogy. The purple lines here, this is something called the danger indicator. No worries there. This is explained in another video that's available to you as well. Okay, we'll get to that in another video. But these are the thresholds. By the way, this VXX signal occurred in 2011. Let's go take a look at that, because this thing lasted about 3 months. In 2011, we had a signal to go long the VXX in August at 15.5. We got out over here at 23.44.5. That was a gain of over 50% right there. Just outstanding. One final point I want to make before we wrap this up, and that is that the premise behind the system is that we always want to be in a position to take advantage of a strong daily roll. A strong daily roll. Now, how big can those daily rolls really be? What's the big deal here? Here's an example, again, from January 2nd of this year. Okay, where when the SVIXY was at 132.78, we have an indicator here called the daily roll effect for the SVIXY. SVIXY DRE, or daily roll effect. We're calculating that with the SVIXY at 132.78, that day's daily roll was 58 cents to the positive. Now, how much is 58 cents relative to 132.78? When you run the numbers, it works out to something just under 0.5% at 0.44%. Now that's for just that day. Just that day. 30 calendar days, okay, times 0.44. You're looking at a rate there at about 13.2% for the month. For the month. And so that's outstanding. And look, that 0.44%, you know, when we have a position on, all right, that number can be much greater. 0.44% is kind of right in the ballpark, if not a little bit underneath the normal range where we want to be if we have a position on. And so you know, that's pretty dramatic. You know, if you only have a position on where you have a strong daily roll like this level, and you are never in the market with a negative daily roll or a flat daily roll, you can see then, I hope, how your money can grow at an exponential rate like this. And so we want to give you the opportunity, if you're interested in allocating some of your capital towards this approach, What do you do now? We want you to do one general thing, and that is educate yourself further. You can go to our VXXTradingSystem.com website. We want you, or you could go to the email you received with this. We want you to register for the ebook if you don't already have it, and we want you to watch 2 more videos just to make sure you understand how these signals are being generated. So you can look at that email. There's some links there. Go watch the videos. There's 2 more done by Len Yates with some fantastic animation software. We want you to read the ebook that explains everything I explained here and more. Educate yourself, and if you want to do this, we want you to go to our website and subscribe. VXX Trading System, hit subscribe now. It's $1,200 for 12 months, for 12 calendar months, and with that $1,200 for 12 months, you get emailed trade alerts and signals. We give you the signals as they come out in the middle of the trading day. We don't wait till the close and tell you, hey, you know, sorry you missed it in the last 20 minutes. No. You have several hours. So we always give those signals out with at least a couple hours to spare in the trading day. Enough time for you to get to your computer. We do not yet have auto trading with the broker. Okay, no real plans that I can tell for us to do that. We email out our trade alerts. We give you access to all of our proprietary indicators and more through our member section of our website and also within the OptionVue software itself. And we give you monthly status emails and access to our subscriber forum as well. Okay, here's a screenshot of your OptionVue quotes display. It's also duplicated on our member section of our website where we show you the VIX futures. We show you the other indicators I mentioned, the daily roll effect for the VXX. Yes, VIXI daily roll effects you can see here. And this was kind of a, let's see, this was kind of a flat period when this was taken. And but this is what's duplicated on our website as well. Okay. And anything else? Nope. Any questions, folks, please call 847-816-6610, or you can go online to order, but we have folks here that can answer all the questions you have about this and more. Okay? Excellent. Any questions at this point from those that are watching live? Go back up here. Okay, the things we'd like you to do. Excellent. Folks, thanks so much for joining us today. I appreciate it. We'll talk to you next time. Take care. Hope to hear from you. We'd love to help you achieve your goals. Bye-bye.